Hello, and welcome to our presentation for our investment analysis project. Our team will be exploring investment opportunities in the crypto ecosystem. This is what to look forward to in our presentation. The essence of crypto are the decentralized networks or blockchains that facilitate this digital economy. We will begin by establishing a quick overview to understand the backbone of this ecosystem. We will then take a look at the main asset space as it currently stands and how different technologies and platforms correspond to different assets. Next, we will look at our footprint in the crypto ecosystem. This is the first stage that investors are facing when stepping into this world. So we will summarize their main options for creating accounts and browsing platforms. The goal of this analysis is to introduce the different investment products currently offered in the space and the dynamic ways through which different platforms correspond to each other. We will explore these through some specific examples and look at some platforms and their products and how investors can use them. Lastly, we will share the main points relating to the investment strategies currently relevant and applicable in this product space. Now let's take a quick look at the technologies on top of which this crypto ecosystem is built on to understand the value of these assets relating to this technology. The basic concept is that of a blockchain. A blockchain is a chain of unique blocks, and a block is just a chunk of information. Specifically, each block holds a record of transactions. Now, the way that this works is that there is a network of decentralized computers, in this case, servers, that compete under some frameworks with each other to pretty much make these difficult computations, which is this concept of mining. Servers compete with each other, and once a server completes this very difficult computation, it is considered a valid process because there's this proof of work that has been done by the server. And then this server can upload a new block onto the blockchain that includes new transactions that have been posted on the network while this new block was being mined. Another way that validation takes place in blockchain networks, and this is, for example, how the network Ripple works, is that computers listen to transactions as they are being posted on the network by users like me and you, and they post them onto their ledger that sort of explains the state of the network. And the way to validate which transactions are legitimate is by comparing their records with the records of other servers that are in their trusted group. This is a decentralized system, but unlike the first case where different servers just compete on their own, this system requires a level of trust. This is how Ripple works, while the first case is closer to how Bitcoin or Ethereum work, where you don't need to trust the counterparties in this network. Basically, what these blocks contain is the blockchain ledger. Now, within the ledger, transactions correspond to addresses, and under many frameworks, the information that is hosted on the ledger is encrypted. The addresses can correspond to two things: either user accounts, so the address of what we will learn later is your wallet or your account, or in some cases on Ethereum, for example, the addresses can correspond to independent contracts that are deployed on the blockchain. Now, we will learn what smart contracts are very soon. Basically, what are the three asset types in this ecosystem? The main one that we are all familiar with are coins, or what we colloquially call cryptocurrencies. Now, coins correspond to different frameworks and applications, and they carry the value of this underlying technology. For example, in order to understand this, consider the coins Bitcoin and the coin Ethereum. These coins carry the value of operating on the Bitcoin, or Ethereum blockchains. The miners that we introduced earlier are rewarded these coins for carrying all these computations and for being responsible to validate transactions that are on the network. Also, these coins carry a value, assuming that they represent active markets and that they are a useful means of transaction where people will use them as other currencies in the world. More often now, we see assets that are only tradable with cryptocurrency. We can take a look at the world of NFTs, for example, that are pretty much digital assets. And in some platforms, NFTs are only tradable with Ethereum. So you can understand and make an assumption that similarly to how someone will be interested in exchanging USD for euros to access assets that are limited within the Eurozone, someone will also be interested to exchange United States dollars for Ethereum to have access to digital assets that are only accessible through Ethereum. So this is sort of a value that they carry compared to the United States dollar, if we can use it as a comparison or a baseline. Also, coins can be developed on top of other blockchain technologies. As an example, Ethereum is a blockchain. It has Ether, ETH as its code, as its coin that it rewards miners and you can trade on. However, on top of Ethereum, you can build your own coins, and there are plenty of frameworks that work in this way with coins that are built on top of Ethereum and do not represent a new or independent blockchain. One more type of digital asset is tokens. The most basic way to understand this is tokens are types of notes of ownership that can correspond to digital assets. An example that many of you might be familiar with are NFTs, non-fungible tokens, which in this specific scenario establish a sort of uniqueness and are a way of recording how a digital asset is owned specifically by a very easily identifiable and unique address that corresponds to a real person or entity that owns it. There are ways in this scenario that you verify who owns an NFT in case it is valuable and a transaction needs to take place. Lastly, we have smart contracts, which are some of the more flexible types of digital assets. And a smart contract, for example, can be deployed on the Ethereum blockchain. And smart contracts, in some ways, deploy code on the blockchain that obey certain parameters and have certain functions. So it's pretty much a way to upload code that cannot be changed. And these contracts are sort of interactive in the sense that someone can trigger the processes that are coded within a contract. And in this case, maybe complete different transactions, change different balances. Contracts can sort of carry their own accounts, as we introduced earlier, and carry their own balances and sort of represent an independent entity within different blockchains.
In the current state of things, there are several types of assets, as we introduced. However, most of them tend to be not independent blockchains, but coins that are built on current blockchains, but represent some specific value or use case. Just to take a look, these are some of the many coins that are currently offered in the market, and in many cases attract investors for different reasons. And we will look a little bit further into how a portfolio can hold different types of coins, and how a balance can be made by using specific products. If we can identify some of the more popular and widely used coins in this family that we're just sharing here today, which is just a sample really of a subset of what is really out there. We can identify Bitcoin and Ethereum. These are two coins that are directly related to blockchains, as we introduced before. But we can also see, for example, Binance coin, which in this case is a coin that relates to the crypto exchange Binance, and its inherent value is that it enables a bunch of transactions, within that exchange ecosystem. And we will look further into what crypto exchange really entails in a very little. There are also stable coins. Stable coins are cryptocurrencies that have the same technological characteristics and adhere to the same frameworks as other coins, however, have their values pegged to the US dollar more commonly. And this is usually done by them being represented of big platforms and big organizations that are willing to hold the necessary collateral in order to maintain the fixed exchange rates. And we can see that some of these stable coins do relate to big platforms such as Binance. As we introduced earlier, they have their Binance coin, but they also have a stable coin. Gemini dollar, Gemini we'll see is another big platform that offers many products, Tether, and many more. And then we have the family of tokens and different frameworks that are built on top of Ethereum or other blockchains. And you will see in many cases the concept of DAOs, decentralized anonymous organizations, which are a step further of an implementation of different decentralized contracts and combinations of these tokens and concepts of ownership that are on a decentralized network. However, we see that there is a plethora of these assets that are spread out within this market. And the way that we can control and access all these different assets on different platforms is through our accounts. And our crypto accounts have some peculiarities that we would like to analyze. So what is a crypto account here? We will make a distinction between two types of accounts. We will distinguish between decentralized accounts, which are similar to what we introduced earlier on in the presentation as we were talking about accounts, and centralized accounts. Decentralized accounts are usually unique and encrypted. They are directly part of the blockchain, and they are independently secured in most cases. They relate to an address, as we talked earlier, that is part of a blockchain. So a user that has an Ethereum account, for example, on the Ethereum blockchain can directly hold Ethereum in their balance. And in most cases, these accounts can be held by investors in their crypto wallets, which can also be used to create new accounts for different blockchains that a user would like to have an account on. And these can be usually done from a single wallet, and we'll look into wallets very soon. And then we also have the decentralized accounts, which are pretty much just platform accounts, just what you can expect with any big digital platform. They have their own systems, and the accounts are centralized and controlled by them. The security, they are responsible for all the encryption and all the data collection. And these we will see relate to many of the bigger platforms that are centralized in this ecosystem. Now, to understand a little bit better how crypto accounts on the blockchain relate to crypto wallets, as we said, the accounts are registered on the blockchain. They can send transactions. They have these unique addresses, and they have their balances. They are the most basic type of information that is held on the blockchain in terms of a stakeholder, and they are the backbone of how transactions are committed and controlled. And as we introduced earlier, these are the accounts through which contracts also are controlled, and transactions and balances can move around. The best way to create accounts and hold them safely are usually wallets, and crypto wallets are of three main categories. Hard wallets. Now, hard wallets, basically what you need to understand is that they are similar to USBs. They are offline wallets. They are stored in what we call cold storage offline. You will usually plug in, let's say, your USB onto a connected device, and through the necessary framework interact with your account. However, the information on your account and about your account is hosted in that offline storage that you are physically responsible to secure, and there is no digital information that needs to be then stored safely. And of course, the history of transactions and that your account has been part of is on the blockchain. However, information about your account is saved offline, and that provides a lot of security against digital hacking and digital manipulation of your accounts. However, it does require a certain level of organization and planning when hosting these assets locally in a physical space. And then we have mobile and desktop wallets. Consider the USB just the hard drive of your computer or your mobile phone. They are hosted locally on your device, and as such secured within the premises of your device. However, if your device gets somehow affected, or someone has access to it, then they can also manipulate those accounts and those wallets stored on it. And then we have web wallets, which are wallets hosted on web platforms like we can consider sort of MetaMask and many of the other sort of wallet types. And of course, they are encrypted, but the platforms that host these wallets online are responsible for their security. Different wallets have wide ranges of different functionalities, many of them, and the most used ones are multi-chain, meaning that you can have an account on different blockchains on the same wallet if you would like to hold Bitcoin and Ethereum at the same time and access many different networks for several reasons. And also they provide the ability to have sort of a singular account functionality, since in many cases, many of these platforms that are on the crypto ecosystem do not hold accounts on their own platforms, but allow you to sort of log in and provide credentials from a wallet of yours, and they sort of sync up with your wallet immediately instead of having to hold your personal information. We can see some of the characteristics that different wallets may have. And in this case, it is important to point out that different investors, in this case, that are willing to have crypto wallets for security reasons or functionality reasons might want to look into what different wallets provide as functionality and what is more important to them, to make that decision of which wallets are most useful to them. And at last, we have our centralized or exchange accounts, which the rest of the presentation and the crypto products that we'll analyze relate to mostly. The way that we should understand this is that these are pretty much, as we introduced earlier, platform accounts, or they're very similar to brokerage accounts when we are talking about exchanges such as Binance or Coinbase. Basically, the blockchain accounts that hold the underlying assets are independent of the users. The companies such as Binance and Coinbase are responsible for maintaining their own user accounts and their own sort of bottom line and which user holds which assets. However, the way that they interact with the blockchain is much more centralized, and they have their own accounts that correspond to different assets. This also enables them, in many cases, to perform transactions internally within their independent ecosystems, and in such a case, sometimes provide very low fees for crypto transactions that would usually cost much more. In that scenario, a real crypto transaction does not take place, since the money, or in this case, coins, do not move from the accounts that, for example, Coinbase holds. They just move to different user correspondents within the Coinbase ecosystem. And as such, Coinbase can provide the transactions of cryptos with really low fees. But that does not necessarily, in some cases, relate to real coins being transacted on the blockchain. And these transactions will not be reported on the blockchain accordingly. There are many different sort of exchange controls that underlie different assets, and we will see how this enables many of these different platforms to provide many different products that are much more advanced than what their underlying blockchains are capable of hosting. And of course, sometimes we can link these platforms to a wallet account in case we want to take our assets outside of the platform and store them in our personal wallets and as such personal accounts.
All right, so we're going to be giving a little bit of an overview of some of the products that are offered in the cryptocurrency space. So there are options and futures available. Futures are pretty easy to come by. They're offered on a pretty big range of platforms. They're usually pretty liquid, at least for the more major exchanges, and they offer a pretty wide range of coins and indexes. For example, FTX offers 190 different perpetual futures on coins, and also offers indexes for stuff like decentralized finance baskets of coins or baskets of altcoins, which allow you to gain exposure to those things without having to individually buy each thing. So for options, options aren't offered on quite as many platforms. They're usually not quite as liquid, and the contracts can be very expensive. This is because pricing Bitcoin options is a little different than pricing stock options, because the way the payoffs works, the Black-Scholes model doesn't work on it as well. This also results in some pretty enormous spreads. As you can see in this screenshot, the top one, the current price of Bitcoin is around $37,000. So for options that are in the money, the spreads are in usually a few percent. And then as soon as you get out of the money at $38,000, the spread is 22%. And after that, it's 76%, and then hundreds of percents, which is much larger than call options for stock like Apple, which is shown below, where the spread is usually in around 1%. The options are usually only offered on Bitcoin and Ethereum as well, just because of low liquidity. They don't want to dilute that anymore by offering other coins.
So now we'll be talking about crypto interest accounts. So these accounts let you earn interest on digital assets that you bought. So you agree to lend out coins in exchange for interest. So this is similar to how savings accounts work at banks. You first deposit money, then the bank lends it out and pays you back plus interest. And you can generally take your money out anytime. So a key benefit that attracts people to these interest accounts is that rates can be very high. So Celsius offers rates from around 9% to 14%. And similarly, BlockFi offers around 9.5%. So in comparison, regular banks offer an average interest rate of around 0.06%. And also there are risks with crypto that help justify these high rates. First, there is no deposit insurance for crypto interest accounts. This means that there is currently no government guarantee on the accounts. Also, there are more than 13,000 different cryptocurrencies being traded, and it's extremely unlikely that this number will stick in the future, which might make the interest accounts in the coins that may go under in the future completely worthless. Something to note is that there's a key difference between interest accounts and crypto wallets. The big difference is interest. And an interesting thing to note is that not all of these crypto banking institutions provide interest the same way. Some do not compound interest, and that means that one has to essentially spend or trade the interest to realize the gains. And other firms provide interest through their own personal coin instead of the coin the interest account is in, while some firms provide interest through combinations of in-kind and in a different currency. So the exchange that we are using as an example is Celsius. And so there are currently like a couple of firms that provide these services like Coinbase, BlockFi, and Celsius. And Celsius is considered one of the best places to open crypto accounts due to their high interest rates, their ability to provide accounts for over 40 different coins, their $0 withdrawal fee, and their high sign-up bonuses of $10 to $600 for new customers. So Celsius provides two different ways to earn interest. The first way is through an in-kind APY, which provides interest using the asset the account is in. And the second way is through the Celsius utility coin, CEL. The second way has an interest rate that is up to 30% higher than the in-kind interest rate. And the only way to be qualified to receive interest through CEL is to sign up as a platinum level accredited investor. So now on the next slide, we'll be moving on to crypto lending and borrowing. So crypto lending goes hand in hand with crypto interest accounts. It means the same firms and exchanges that provide interest accounts also deal with lending and borrowing of the deposited crypto assets. And similar to the traditional banks, borrowers can also stake their currency as collateral. There are usually two different types of crypto loans, so flash loans and collateralized loans. And collateralized loans are what firms like Celsius deal with, and flash loans are an interesting type of loans that are useful for arbitrage. So if a token's value is different in different platforms or pools, and if one doesn't have the funds to purchase the token from one pool and sell it in the other pool, you could just borrow from the lower value pool and sell in the higher value pool through a flash loan. And the other type of loan is collateralized loans. And these are loans that firms like Celsius deal with. And this is similar to regular banks. And Celsius makes it very transparent how much collateral, depending on the currency one currently has, corresponds to the loan amount and loan currency. So currently borrowing is not as popular as Celsius, but Celsius has a competitive APR of around 1%. And plus more and more states are now opening up their regulation to allow for crypto loans, as seen in California recently allowing for these loans. So on the next slide, we'll be shifting to crypto swaps. So a swap is basically when you exchange one cryptocurrency you hold for the equivalent value of another cryptocurrency. And it basically combines the functions of centralized and decentralized exchanges by allowing trades between two different tokens belonging to two different blockchains. So instead of having to convert fiat to currency or migrate to a different blockchain, swaps directly exchange coins from the original trading account. And they can be directly compared to how foreign exchange works. A few exchanges currently offer swaps, but with some fees. So Celsius wants to offer swaps with no fees. So Celsius is currently in the beta stage of crypto swapping, so they haven't opened it up to all users. So on their website, so basically a user inputs the amount and the currency that they have, and then they select which target currency that they would like to receive in exchange. So Celsius provides the exchange rate, and they get this exchange rate through working with third parties to basically get a spread, and then they choose the midpoint of the spread. So in terms of the future of swaps, one of the Celsius founders stated that in the future of the metaverse, mainstream zero-fee crypto swapping would make it easier to trade in various different currencies in order to pay for NFTs and anything else metaverse related. So this means that it'll become easier to pay for something using different cryptocurrencies instead of being restricted to using only one certain coin. So now we'll be moving on to the strategies section.
So we're going to now talk about the different investment strategies that these platforms offer for the different crypto products available. So first, we'll focus on crypto options and futures, which mimic the traditional derivatives market on normal stock exchanges, except with cryptocurrencies as the underlying assets. And there's two main reasons why an investor would take part in options or futures for cryptos. The first is hedging. That's where you invest in contracts that are inversely correlated with the vulnerable assets in your portfolio in order to decrease risk. And with crypto, investors are facing elevated levels of volatility and hence higher levels of risk. And this increases the need for hedging out the risk by using strategies like spreads and protective puts or protective calls. Future contracts can also be used to minimize the risk by locking in a given price for cryptocurrency and avoiding potential future price movements. The second form of investing is speculation, where individuals basically take a specific position on the market based on a bullish or bearish outlook of an asset. And basically they're betting on the future price movements of the underlying cryptos. Options provide a source of leverage because they're cheaper than buying the underlying asset, in this case, the underlying cryptocurrency. And also because of the high volatility of the crypto market, there's opportunities for higher profit levels for both options and futures contracts. So next we'll talk about the exchange market. And this market functions very similarly to the foreign exchange market, except investors are swapping cryptocurrencies rather than traditional currencies. Similar to derivatives, investors use these contracts mainly to either minimize risk or to speculate. So for example, if a portfolio lacks diversification and is really heavily condensed in one type of coin, then the risk could be decreased by swapping a portion of the portfolio or the entire portfolio to other coins. And there's also stable coins available, like the coin Tether that follows the US dollar. And these stable coins follow the patterns of flat currencies, and they generally are not very volatile. So if an investor wants to decrease their risk, either temporarily or permanently, they can swap to these stable coins. For speculation, if an investor believes that the relative appreciation or depreciation of the given currencies doesn't match the spot rate of the contract, then they could potentially profit from these contracts by basically betting on the future currency market movement of these two currencies in the contract. The next product that we're going to talk about is coin lending and borrowing, where, like we talked about earlier, individuals can take out loans using their cryptocurrency holdings as the collateral. And the higher level of the collateral, the lower the rate that can be locked in. And because of the high risk of the collateral, which is the cryptocurrency, the rates on these loans are usually much lower than traditional personal loans. And investors can really customize their risk level to lock in the desired rate. Basically, investors can directly take out loans with crypto rather than converting the crypto to cash first. And this allows investors with long-term crypto holdings that are seeking cash loans to do this directly. So finally, we have crypto interest accounts. These are similar to normal savings accounts with investors earning interest on their cryptocurrency, and the interest rates vary by the coin used, with stable coins receiving lower interest rates and more volatile currencies receiving higher levels of interest. And these accounts do have higher risk levels than traditional savings accounts, since the underlying currencies tend to be really volatile and the platforms are not really as heavily regulated as traditional banks. So as a result, the investment trade-off is that the savings account has higher risk than traditional savings accounts, but it's also giving you higher returns likely and more overall flexibility with the lack of regulation. The savings accounts mostly appeal to longer term investors who have crypto that they don't plan on actively trading and they want to earn interest on these holdings.